Big tech didn't slow down AI rollouts because it lost belief in AI. It slowed down after spending billions on it. And that timing is exactly what makes this moment so important to understand. For the last few years, the dominant story was speed. Build faster, deploy sooner. Get AI into as many products as possible. Whoever moved first would define the market. That mindset unlocked massive spending on chips, data centers, research teams, and infrastructure at a scale the tech industry had never seen before. Now, after those billions have already been committed, something has changed. AI features are rolling out more slowly. Enterprise deployments are taking longer. Consumer launches are quieter, narrower, and more controlled. On the surface, it looks like hesitation. In reality, it's a shift in incentives. Why big tech is slowing AI rollouts after spending billions starts with accountability. Early AI investment lived in a hype-friendly environment. The promise of transformation mattered more than measurable results. Investors rewarded ambition. Boards accepted inefficiency. The assumption was that once the technology matured, monetization would follow. That assumption is no longer enough. Once spending reaches the tens of billions, AI stops being a vision and becomes a balance sheet issue. CFOs start asking uncomfortable questions. What is the real cost per user? How does usage scale relative to revenue? What happens to margins if adoption accelerates faster than pricing power? Those questions don't kill innovation, but they absolutely slow deployment. One of the biggest reasons AI rollouts are decelerating is cost visibility. Running large-scale AI systems is far more expensive than many companies initially projected. Compute costs remain high. Energy costs fluctuate. Hardware depreciation is real. Every additional query, prompt, or interaction carries a marginal cost that doesn't disappear with scale the way traditional software costs did. When usage grows faster than monetization, AI becomes a margin risk. Big tech is now realizing that deploying AI everywhere, all at once, can actually weaken profitability if it isn't tightly controlled. Slowing rollouts allows companies to manage where AI is used, how often it's invoked, and whether it creates enough value to justify its cost. Another major reason for the slowdown is reliability. Early AI demos were impressive, but they lived in forgiving environments. Errors were acceptable, hallucinations were tolerated. In production systems, especially in enterprise settings, that tolerance vanishes. When AI touches legal documents, financial data, healthcare workflows, or core business operations, mistakes carry real consequences. Regulatory exposure increases, liability increases, brand risk increases. A single public failure can undo months of progress. As a result, companies are taking more time to harden systems, narrow use cases, and reduce unpredictability before scaling further. This isn't fear, it's risk management. There's also a human constraint that doesn't show up in headlines. AI is not just a product layer. It changes how organizations work internally. Rolling out AI at scale requires retraining employees, redefining responsibilities, and rebuilding processes that were never designed for automation or probabilistic outputs. You can buy hardware quickly, you can't rewire a workforce overnight. Big tech is discovering that the bottleneck to AI adoption is no longer technological capability, it's organizational readiness. Slowing rollouts gives companies time to adapt internally without breaking operations. Regulation is another powerful force shaping this pause. Even before formal rules are fully finalized, companies can see the direction of travel. Governments are watching AI closely. Data usage, model transparency, bias, and accountability are all under scrutiny. Aggressive rollouts today could create compliance problems tomorrow. So instead of pushing everything live immediately, companies are staging deployments, limiting exposure, and building internal governance frameworks first. That caution looks like a slowdown from the outside, but internally it's seen as necessary preparation. Investor expectations have shifted as well. Markets are no longer rewarding AI spending just for its own sake. Investors now want to see discipline. They want evidence that AI can improve margins, not just capabilities. They want fewer promises and more proof. That changes executive behavior. Leaders are under pressure to balance competing goals. Stay competitive in AI, avoid runaway costs, protect trust, deliver returns. That balancing act naturally slows execution, especially when the downside of moving too fast is so visible. Another underappreciated reason big tech is slowing AI rollouts is prioritization. Early on, companies experimented by adding AI everywhere. Search, productivity tools, customer support, advertising, coding, analytics. Over time, it became clear that not every integration delivered meaningful value. Now, companies are pulling back to focus on fewer, higher impact use cases. That means delaying or canceling features that don't clearly improve outcomes. Less visible activity doesn't mean less progress, it means more selectivity. There's also a strategic patience emerging. Being first is no longer the same advantage it once was. Being reliable, trusted, and economically sustainable matters more. Companies are watching competitors closely, learning from public mistakes, and avoiding rushed launches that could backfire. In this environment, slowing down can actually be a competitive move. Importantly, AI investment itself has not stopped. Spending on infrastructure continues. Research continues. Talent hiring continues. What's changing is the pace at which AI capabilities are exposed to users. Behind the scenes, development is still aggressive. On the surface, releases are cautious. This creates a disconnect. Headlines talk about an AI revolution, but users experience incremental change. That gap exists because big tech is transitioning from hype-driven deployment to economics-driven deployment. And that transition is uncomfortable. Why big tech is slowing AI rollouts after spending billions ultimately comes down to expectations. AI is no longer allowed to be experimental. It's expected to work, to be accurate, to be secure, to justify its cost. Meeting those expectations takes time. What looks like hesitation is really recalibration. Companies are learning where AI creates real value and where it simply creates expense. They're learning how to scale without damaging margins, trust, or operational stability. This isn't the end of AI momentum. It's the moment where AI stops being treated like a moonshot and starts being treated like core infrastructure. And in big tech, once something becomes core infrastructure, speed always gives way to control.